day, everyone, and welcome to the Blucora fourth quarter earnings results conference call. This call is being recorded. With us today from the company is the President and Chief Executive Officer, Bill Ruckelshaus, Chief Financial Officer, Emans, and the Senior Director of Investor Relations, Stacy Ybarra. At this time, I would like to turn the call over to Stacy Ybarra. Please go ahead, ma'am.
Good afternoon, and welcome to Blucora's investor conference call to discuss fourth quarter and full year 2013 earnings. Before we begin, I'd like to remind you that during the course of this call, Blucora representatives will make forward-looking statements, including but not limited to statements regarding Blucora's expectations about its products and services, outlook for the future of our businesses and growth initiatives, and anticipated financial performance for the first quarter 2014 and tax season 2014. Other statements that refer to our beliefs, plans, expectations, or intentions, which may be made in response to questions, are also forward-looking statements for purposes of the safe harbor provided by the Private Securities Litigation Reform Act. Because these statements pertain to future events, they are subject to various risks and uncertainties, and actual results could differ materially from our current expectations and beliefs. Factors that could cause or contribute to such differences include, but are not limited to, the risks and other factors discussed in Blucora's most recent annual report on Form 10-Q on file with the Securities and Exchange Commission. Blucora assumes no obligation to update any forward-looking statement, which speak only as of the date the statement is made. In addition, during this call, our management will discuss GAAP and non-GAAP financial measures. In the press release, which has been posted on our website and filed with the SEC on Form 8-K, we present GAAP and non-GAAP results along with reconciliation tables and the reasons for our presentation of the non-GAAP information. We have also provided supplemental financial information to our results in the Investor Relations section of our corporate website at www.blucora.com and filed with the SEC on Form 8-K. Now I'll turn the call over to Bill Ruckelshaus. Following his comments, Emans will review the fourth quarter results and first quarter outlook. Then we'll open it up to your questions.
Thank you, and good afternoon. We have a busy agenda today. I want to begin with a few brief comments in response to a report published recently about Blucora. As a matter of practice, we do not comment on individual reports. However, given the nature of the accusations this week, we feel it is important to set the record straight. While we will not take time on this call to address every inaccurate statement in the report, we do want to specifically respond to the allegation regarding illicit keyword search terms. I will be very brief and then move to our operations where we continue to be focused. Blucora and our InfoSpace subsidiary have zero tolerance for illicit keywords of the sort referred to in this week's report, and we have long-standing procedures in place to suppress such search terms. The contention that our business is built around this type of traffic is irresponsible, abhorrent, and diametrically opposed to what we stand for as a company. Fully removing illicit keywords from a search network is an ongoing battle for all industry participants. This is all the more challenging in the case of code words and euphemisms that are ever-changing. While our systems and filters are robust, they require constant evolution. The suggestion that we are deliberately seeking this traffic or that we are financially dependent on it is false and despicable. Other aspects of the report, too numerous to mention, including claims of involuntary and artificial clicks impacting the quality of our network traffic, are also false. We will not dignify this report with further comment. With that, I will move to updating on our businesses. The InfoSpace business performed above our expectations in both the fourth quarter and for the full year 2013. Our strong revenue growth can be attributed to both our owned and operated properties and the addition of new search distribution partners. Our team has been working closely with Google over the prior months, and we are pleased to announce today we have renewed our contract together effective April 1st, 2014. The 3-year agreement extends the partnership through 2017 with a mutual option to extend for another year. Importantly, our new agreement applies to desktop only and excludes smartphone and tablet search going forward. This represents a change from the terms in our current agreement and will drive InfoSpace to evolve our mobile offerings going forward. Mobile is a modest component of our search business today, but clearly the potential exists for us to broaden our exposure in this evolving market in the future. By way of background, Google communicated to us late in our renewal discussions. They are reviewing their syndicated mobile search offering, and as a result, this renewed agreement does not include the mobile search product going forward. Given our long-standing relationship with Google, we are optimistic we will find new ways to work together in mobile in the future. In the meantime, our search team is ready with alternatives to Google and mobile. Our immediate response will be to display mobile search results from other sources, including Yahoo. Longer term, we will continue to experiment with search and non-search solutions, including programmatic display, text, and video, to evolve our offerings in mobile and remain relevant to users and partners as mobile usage further matures. There are a number of important things to consider in connection with this announcement. First, I want to underscore that the vast majority of our search business today is desktop related, and desktop will continue in the new contract under the same rates that we have in our current contract with Google. Desktop was 85% of our business in Q4, represented nearly 2/3 of our revenue growth from last year, and grew at a compound annual rate of approximately 28% from 2010 to 2013. Second, our value proposition in the search marketplace continues to center around bringing liquidity and quality traffic to our search engine partners and differentiated content and monetization solutions to users and partners. This core equation remains intact and continues to offer InfoSpace and our partners compelling opportunities going forward. Last, the InfoSpace team is experienced, and our diversified model allows us to quickly adapt to market changes. We will navigate to a new baseline and continue to deliver value in this new chapter. Now turning to tax prep. The tax season is underway, and the tax team is poised for strong performance. This year brought another delayed start to the season, and we believe the filing pattern overall will be very similar to last year. Consumers are increasingly conditioned to start their tax returns later in the season. TaxAct delivered and launched a record number of new products and enhancements this season, centered around user experience, website content, and decision support. We migrated our small business DIY tax solution online, launched a consumer-facing healthcare insurance site at healthcareact.com, and introduced a number of applications including a tax calculator, mobile refund tracker, and mobile donation assistant. The team also launched ahead of this season a differentiated smartphone app for tax filing, TaxAct Express, for free federal tax filing. With TaxAct Express, TaxAct now offers a suite of tax filing products for desktops, tablets, and smartphones with anytime, anywhere access. The team is firing on all cylinders, and I couldn't be more pleased with their progress. We entered the tax season with increased momentum, best-in-class products, an outstanding value proposition, and programs aimed at increasing consumer awareness. We feel good about how TaxAct is performing to date and believe we are well situated going forward to grow in digital DIY and bring more value to our customers. Now turning to e-commerce. The condensed holiday shopping season and soft consumer demand led to fourth quarter sales slightly below expectations. Some of this softness is carried over to Q1, and while we don't believe the issues to be long-term, we are nonetheless guiding cautiously in the first quarter. We purchased Monoprice because of their compelling value equation. They provide quality products at fantastic prices and deliver great service. Their core customer base, strong product reviews, and high net promoter scores speak to the loyalty they generate. We continue to believe in the growth potential and remain committed to the multi-year vision of growing Monoprice into an established household brand. In closing, 2013 was a year of growth and continued transformation for Blucora. We are executing well on the blueprint in place and look forward to seeing our companies advance on their respective paths in 2014. With that, I'll turn the call over to Eric.
I will start out with a quick review of our full year 2013 consolidated results before moving into a more detailed discussion on our fourth quarter performance and in my comments with first quarter 2014 outlook, as well as some commentary on the 2014 search expectations given our Google renewal. Consolidated revenue for 2013 was $574 million, up 41% versus prior year, and adjusted EBITDA was $114.2 million, up 42%. These results reflect strong growth in our search business, which was up 24% and 33% on a revenue and segment income basis. Our tax business was also up considerably, in part due to a full year of results versus 2012 due to the timing of the TaxAct acquisition. Additionally, our 2013 results benefited from the acquisition of Monoprice in the third quarter. Non-GAAP net income for the year was $97.7 million, or $2.25 per diluted share, and GAAP net income was $24.4 million, or 56 cents per diluted share. On a pro forma basis, which includes the acquisition of Monoprice for the full year, consolidated revenue for 2013 was $666.2 million, adjusted EBITDA was $127.6 million, and non-GAAP net income was $106 million, or $2.44 per diluted share. Pro forma free cash flow for the year was approximately $107 million. Further detail on our pro forma results can be found in our supplemental information release in the IR section of our corporate website. We exit the year with a strong balance sheet with cash, cash equivalents, and short-term investments of $333.7 million and net cash of $11.1 million. During the year, we repurchased approximately 417,000 shares for approximately $10 million. And under the current share repurchase plan, we still have $40 million we can put to work. Turning to our fourth quarter performance, consolidated revenue was $167.3 million, and adjusted EBITDA was $22.6 million. Non-GAAP net income was $18.1 million, or 40 cents per diluted share. It is worth noting that the non-GAAP diluted share count for the quarter included approximately 1.8 million shares related to the conversion premium and our convertible debt, as our average share price for the quarter exceeded the conversion price. During the quarter, we recorded a GAAP net loss of $1.1 million, or a loss per share of 3 cents. The net loss was driven by a non-cash loss of $5.7 million, or a loss per share of 13 cents related to a derivative instrument for a warrant that was exercised during the quarter. Normalizing for the impact of this charge, we would have exceeded our net income and diluted EPS expectation for the quarter. Moving on to our segment performance, beginning with our search segment. Revenue for the quarter was $125.6 million, and segment income was $25 million, up 30 and 44% respectively from the same quarter last year, carrying the momentum we had exiting the third quarter. Owned and operated revenue was up $14.7 million versus prior year as we continue to acquire new users through marketing and investments. Distribution revenue was up $14.6 million, driven by new distribution partners launched in 2013 of $16.9 million, which offset a slight decline in our existing partners. Segment margin was flat sequentially, but again up versus prior year, benefiting from the growth of owned and operated revenue as well as mix shifts in our distribution partner network. Turning to e-commerce. Revenue for the quarter was $39.7 million and segment income was $4.1 million. As Bill discussed, sales were a bit softer than expected. With that being said, we were pleased with Monoprice's performance in the quarter, which on a pro forma basis grew revenue and segment income 21 and 30% respectively, while maintaining segment margin of 11%. Orders were up approximately 10%, implying a healthy increase in average order value, so all in all, a good finish to the year. Touching quickly on our tax preparation segment, revenue for the fourth quarter was $2 million and recorded a segment loss of $3 million, both in line with our expectations. Closing on the fourth quarter, unallocated corporate operating expenses were $3.5 million, sequentially down as the third quarter included transaction expenses related to the acquisition of Monoprice. With that, let's move on to our first quarter expectations. We expect consolidated revenue between $213 and $222 million, adjusted EBITDA between $51 and $54 million, non-GAAP net income of $45 to $48 million, or $1 or $1.06 per diluted share, and net income of $22 to $24.5 million, or 49 to 54 cents per diluted share. Let's talk through some trends at the segment level that informed our consolidated outlook. Starting with tax, we are tracking to the first half 2014 guidance of revenue of $95 to $97 million and segment margin of approximately 52%, which was provided during our third quarter earnings call. We expect a bit north of 70% of the revenue to hit in the first quarter at a segment margin in the neighborhood of 48%, give or take. E-commerce is off to a slow start, as Bill mentioned, and for the first quarter we expect revenue to be up low to mid-single digits versus prior year, but will be down sequentially. E-commerce segment margin is expected to compress from the fourth quarter to 7 to 8% as we are making some investments primarily in the sales and marketing side of the house, including improving our analytic capabilities. Search again begins the year with headwinds as the team is working to adapt and phase in changes related to our Google renewal. Additionally, and consistent with other folks in our space, we are seeing some pricing softness on our owned and operated properties. As a result, we expect first quarter year-on-year revenue growth to be in the high single to low double digits. We also expect segment margin to compress to 17.5 to 18% range. Before closing, I do want to provide an update on our 2014 search segment expectations adjusted for the projected impact of the Google renewal. Given our current line of sight, we believe we can grow revenue in the low single digits for the year. We expect second quarter revenue will be down sequentially and likely represent a low point for the year as we transition to new mobile solutions. We also believe segment margins may further compress from the first quarter outlook levels, in essence establishing a new baseline for the business. As always is the case with the search business, our visibility out over a few quarters is limited, so we fully expect the 24 expectations to continue to evolve during the year and can be further impacted by unforeseen external factors. The good news is here we have the support of our search engine partners, a diversified partner network, and an experienced team. As we have stated before, the search business is volatile at times, but durable, and we remain focused on driving free cash flow from this segment. With that, let's turn the call over to the operator, and we'll take your questions.